Good morning, everyone. How are you? My name is Bill Heidt. I'm the executive sales executive here at BRMS. We're coming up on 11 o'clock. We have a large audience today. I might just wait another 30 seconds to have people join. I know there was a couple polling questions in the beginning, so that might take a little time for folks to get into our presentation. Okay. All right, I'll jump into things. It's 1 minute after. Again, my name is Bill Heidt. On the line with us is Henry.santos. I'll give you a brief intro here in a minute, but he is the Executive Vice President at AmWINS. In addition to our guest speaker, we will have Shelly, who's the Director of our Sales Division, chime in as well. We have a great presentation today. And before we jump into things, what I'm going to do is just kind of give people an idea as to what's going to happen from an agenda perspective, and I'm adding people. But from housekeeping perspective, really, sorry, what we're going to do here is we'll have Henry present for about 15 minutes. I'm going to just provide a brief open for about 5, and then we'll have Shelly provide kind of a brief overview. We've had most people muted today just because, again, the amount of folks on the call today. On the bottom of your screen or on the top, there's going to be a more option. It's 3 little dots, and there's going to allow you to go in there, and one of the options is a drop down, which will allow you to chat. So if there's a question you have through the duration of the presentation, go ahead and send us over what question it is, and we'll try to most likely answer it towards the end. In addition to this, I want to give a big shout out to Henry and the AmWINS team. They're going to provide a $500 charitable contribution. We'll be doing the drawing towards the conclusion of the meeting. And the way that we'll do that is we're going to go ahead and update everyone who's present on the meeting today. And then what you'll see is sort of a fortune type device where it's going to randomly choose a winner. And we're just going to put the initials of those folks. So I'm getting some feedback. So we'll put the initials there to remain anonymous for our viewers here today. And so in the beginning, we've done a fun kind of polling question that's a bit new for us. And, that gives us some intel as to what's going on with our audience, where we need to kind of focus, provide data and insight. But in addition, there was a fun question that we want to do in order to break the ice. I'm looking at the numbers now, and it seemed overwhelmingly that about 95% of folks want to remain at age 30 to 40. So I think no secret there. As we thought about a topic today, stop loss was very important to us because we're seeing a huge uptick in the amount of calls that we're facilitating from brokers, cases being worked on, and letters of intent for a lot of one-on-one business. I think when COVID started, like many industries, things somewhat slowed, and that was concerning. But what we're noticing as we're being a part of meetings is that businesses have a high level of interest towards self-funding, right? And stop loss being an integral part to that. And as long as we're able to provide a long runway with saying, here's how much money you're going to save, let's review the analytics, and making sure that we have a clear path as to how we're fundamentally going to introduce this concept and get it running, businesses are very open to doing this. I would think in addition to why we're seeing such a big uptick is last evening in preparation for this meeting, I was looking at our analytics over a book of business, which represents hundreds of thousands of lives in hundreds of groups. And what was interesting in the data is we have about a 16% reduction in claims. And so as I think about that to a group, let's just say we have a self-funded group that spends $1 million a year in premiums. The expected, claims were supposed to come in some amount, but now we're, for 16% under, that's an automatic $160,000 in savings. So success breeds additional success, which also creates success stories, right? So our broker community have a strong story to tell to current clients and to opportunities as it relates to clients. And so I think in addition to that, as we think about what COVID has done to the general business marketplace, is that revenues for a lot of companies aren't as strong as they were last year. And so as brokers going back to their prospects and clients, I think this brings up an opportunity saying here, we have some ideas for you, right? You can keep under this fully insured route, premiums are increasing, and for some reasons, that we don't understand, but here's a way that you can control that spend, right? And hopefully reduce costs. And so again, when we thought about presenters today, AmWINS certainly has been a wonderful partner to us. But not only that, I wanted to make sure I brought horsepower to the meeting, right? And so when I look at, AmWINS as a company, they're the largest stop loss wholesaler brokerage firm there is in the country, representing about $1.1 billion of premiums placed, and also just years of service, right? So they've been doing this for a long time, and they have the horsepower. So as we think about stop loss partners to kind of go to as for advice and helping facilitate, AmWINS is certainly at the top of that. Part of our as I transition over to Henry, which is going to take the bulk of this presentation, he's no spring chicken to the industry, having over 20 years of industry experience. He's also the executive vice president, as I mentioned earlier, of AmWINS, running the whole Texas location. He's worked with Fortune 500 companies, assisted public entities, Taft-Hartley plans, and has been really since 2008 focusing in the self-funded space. So certainly a pro. So with that, I'd like to pass it over to Henry. Again, he's going to speak about 15, 20 minutes. He's going to review a case study, and then he's going to transition over to Shelley, who's going to review some of the analytical reporting that we help to help both clients and producers manage this.
Thank you for that introduction, Bill. Appreciate the time everyone has given to us for this. Good morning/afternoon for anyone that is on a time zone other than Pacific time. So with that said, let's get started. And real quick, what I'm hoping that people will get from this is just a really basic understanding of why you want to at least have this conversation with your clients if you haven't done so in the past, or it's been a while since you last did it, just to give you some of the foundation of self-funding and talk about what's going on in the market for a little bit, and then see what the next steps would be if you wanted to broach that topic again or broach it for the first time. Okay, so we're going to get right into to the basics. One of the first questions that I think about is, why do people want to do this? And as you can see from this slide up here, I mean, a lot of employers are already doing this. As you see, 81% of health plans that have anywhere from 1,000 to 5,000 are already self-funded. But more important than that, and more interesting than that, is that when you look at that segment for mid-market that's between 200 and about 1,000, almost half of them are self-funded. And that number has exponentially grown, especially after ACA, removal of lifetime limits, mandated loss ratios, the list goes on and on. Just the proliferation of healthcare, it gets more expensive. We know that, healthcare trend is usually like 16% versus regular inflation trend, which is 3%. So there's just a slew of reasons why we've seen more people or employers gravitate towards self-funded in that mid-market space, because quite frankly, we know that fully insured carriers and that methodology just really isn't sustainable for the long haul, especially if you have good risk. If you're an employer with good risk, why wouldn't you want to take advantage of that? So again, the point just being that self-funding is something that is just garnering more steam for that mid-market. Okay, so I like this slide because it gives a little bit of insight, or helps people conceptualize that maybe are brand spanking new to self-funding and don't really understand the different pieces that go into self-funding or even fully insured premium. So for every dollar that you pay, there's different buckets that goes into in terms of fully insured carriers. So, if you look at the graph on the left, you can see that for every dollar that a carrier collects, basically 80 cents of that dollar is allocated to actual claims expense. So when we think about the U.S. and what the problem is with healthcare and why it's so expensive, most of it is just the cost of care. Yet, from a political standpoint, everybody focuses on, broker compensation. They focus on carriers and what their profit margin is. But Even if you eliminated that, you still have a pretty big problem on your hands. So now if you look over to the right graph there, you can see how in a self-funded environment, you have different buckets, and you have fixed costs that range from administration. You look at the stop-loss premium, that actually is insurance, of course, and then you look at what that margin slice of the pie represents. That's basically, your max liability to expected, and it can, be below that, but certainly not higher than that. So that's where a lot of that savings potential comes into play when you are self-funded. Okay, moving right along. And I should have mentioned this earlier. Because of the time constraints, I'm going to try to move through these slides rapidly, and of course we'll be available for follow-up questions, and there is a deeper presentation which will probably take about an hour to an hour and 15 minutes, specifically on self-funding and captives and all the dynamics, and have more time to really dig in deep. So I apologize in advance if I'm moving a little bit briefly through this. So when you think about financial advantages for self-funding, it really comes down to the money, right? Early in my sales career, someone says, just follow the money, Henry. So we know with fully insured cases, if you pay $1 in premium and your employees only use 25 cents, well, you're out $1. Now, if you're in the self-funded world and you can control claims, and you have a reputable administrator, you have access to reporting, which is a whole other topic that we could delve into, things that you don't get in the fully insured market, especially if you're in that mid-market segment. It just makes sense to be able to be a master of your own destiny, to have actionable reporting that you can use to tweak changes in your plan designs, maybe implement different cost containment type measures, everything from neonatal care to, diabetic type initiatives, smoking cessation, all things that ultimately are going to impact the employer's bottom line. In short, you really control everything from an employer's perspective, and there are tax advantages. There's less premium tax. There's also tax advantages from a standpoint where you're able to build reserves as an employer, as long as you're using them for healthcare expenditures, and the list goes on. And it just comes down to control, if I had to just really put one word on it. As noted before, you have complete flexibility to plug and play everything from network options, administration, different types of cost containment options such as reference-based pricing. If you wanted to go that route, that definitely would be the most aggressive way to be able to control claims. This is something that is governed by ERISA, so it's federally governed, so you don't have to deal with state mandates, for example. And if you're an employer that has employees amongst a lot of different states, you don't have to worry about, in a fully insured environment where you have to have plan designs that were only maybe available in certain states, or differences in network options, and the list goes on. So control improves health and just lower costs. Okay. So essentially what stop loss does, and Bill was absolutely correct in his opening remarks, where it is integral for self-funded plans, with the exception of the AT&Ts of the world, or employers that have 20, 30,000 employees or more, and they have actuaries and they've been self-funded for a long time. They know what their utilization is going to be. They probably don't need stop loss, although some are actually starting to consider it with the proliferation of $1 million plus claims, especially in the specialty market. But that aside, stop loss really is the bedrock for a self-funded plan, because one of the misnomers with being self-funded, and maybe why some employers have been hesitant to do it in the past, is they think the sky's the limit. There's no end to liability. So what stop loss does is be able to help what we call create a box and cap their expenses, both from a frequency perspective and also from a severity claim perspective. So within self-funding and stop loss, of course, there is a section, a bucket, as I like to refer to it, where the employer self-insures those claims, then it claims above those thresholds, a transition to the stop loss carrier. And of course, as noted earlier, there's different programs that you can put in place to manage costs. So what do we mean by building the box? So with stop loss, there's essentially two different coverages, which is critical, especially, again, for that mid-market. I'll keep harping on that since I think that's the greatest opportunity in this market, since there's 53% of companies that are not self-funded in that segment. So specific stop loss is your main stop loss coverage, and that really is for severity claims. So that is going to be for your high dollar claimants, whether they're hospitalized, whether maybe they're on a specialty medication because they have hereditary angioedema, all of your big ticket items, cancers, preemies, et cetera, et cetera. So that specific stop loss coverage kicks in once an employer reaches their deductible, just like any other insurance plan that's out there. So when you think about what an employer is going to be self-funding and where their spec deductible kicks in, depends on a host of things. Primarily has to do with the demographics, the group's size. If we have claims experience, that can also weigh into it. But typically speaking, for that mid-market, it's going to be anywhere from $25,000 to $300,000 per every individual, which sounds like a huge number, and it would be if you had every single person in your plan, meet that deductible. It would just be astronomical, and that's where aggregate coverage comes into place. And with that said, I will transition the slide. Okay, so with aggregate insurance, this is really what caps an employer's expense. And it's designed really for the frequency claims, so everything that's not catastrophic, all your general routine care, doctor's office visits, labs, lower cost maintenance medications, and by combining aggregate insurance with spec stop loss, you're able to build that box, and you're able to arrive at a maximum liability. Worst case scenario, if it was just the most horrendous year that an employer could have, they would know what their max liability is based on those two stop loss coverages, spec and ag. And this is also very important because one of the things that makes it easier for employers to transition, of course, they want to know what the bottom line or the worst case scenario is, but these different components of stop loss help organizations like BRMS and AmWINS. We can actually build premium equivalent rates, like I'm sure you've seen in the level funded market, by tier, so whether it's, single, family, employee, spouse, what have you, and by plan design. So from a conceptual comparison perspective, it's a lot easier for an employer to digest. And there are other features such as aggregate accommodation. That just has to do with the cash flow. If you're in a traditional self-funded plan where it's pay as you go, or even level funded, because you could have claims that exceed in a given month what that monthly aggregate is. So there's essentially a feature in there that helps employers be able to budget and handle that cash flow accordingly. Okay, I'm not going to spend a lot of time here, just in the interest of getting through this. But again, that spec deductible is for severity claims. You see in this example a $50,000 spec. Everything above that would be covered by the spec stop loss, and then everything that falls below that would count towards the aggregate claim pick, as we call it, or aggregate attachment point. Contract types, this is very important, I think, for anybody that might have tried self-funding in the past and gotten burned because of it. Maybe it might have been because someone didn't really explain what contract basis is and how it works. In a fully insured scenario environment, you pay your premium, you don't worry about any run-in claims, run-out claims, but in stop loss, because carriers are dealing with such a small sliver of premium, they have to really have a beginning point and then an end point as to when claims can be incurred and ultimately paid. Also important to note is that there are options if an employer ever needs to get back to fully insured. Maybe they just don't really have good claims experience, or maybe there's some attrition going on because of COVID or furloughs. So there are different provisions such as TLO, terminal liability options, that provide that run-out coverage to help them get back in there. Aggregate corridor, it has to do with your attachment point, and basically the underwriter puts a fudge factor on their aggregate liability claim pick. Usually it's 25%, but it can range anywhere from 10%. Usually 25 is the top. Covered benefits, medical and RX is probably the most, makes the most sense, but if you really wanted to, an employer could have vision, life, and maybe even some other ancillary lines of coverage in there with stop loss. So you've got about 10 minutes. These are some provisions here that if you are familiar with stop loss, you've come across. Spec advance means that the employer doesn't have to pay that entire claim up front. So if it's $1 million claim and they have a $50,000 spec, they fund to their $50,000, which, by the way, if we have premium equivalents and we're collecting those aggregate dollars, a TPA like BRMS would have those dollars on hand to pay that claim. But spec advancement just means that an employer doesn't have to pay that claim in totality up front before the insurance kicks in. Lasers, that's a fancy word for saying that we're going to set a higher specific deductible on a given person above what the rest of the group has, just because we know an underlying or certain condition exists where they're automatically going to exceed that group's spec deductible. Gapless contract, won't spend too much time on there. It's just to make sure that there's no claims that fall out of the contract there. So state of the market, it has been consistently upticking, again, with the proliferation of $1 million claims, but as of late, it's actually been more favorable for carriers. And this ties into what Bill said earlier about, 16% less spend, and even carriers on the stop loss side are benefiting from that because of deferred care, or maybe people now don't have coverage, maybe they went to the exchanges, whatever the scenario might be, but that's good for a host of reasons. Obviously, we can have some stabilization in the rates, maybe do some early, as we call it, locks or early binding for this upcoming 1/1. But traditionally speaking, with everything that's going on in the specialty market and just the cost of care, you've seen those loss ratios continually uptick for carriers. And unlike the fully insured market, where they have a bigger premium volume, of course, with stop loss, their loss ratios need to be more favorable. So a carrier will typically want 70% of every dollar taken in to go to claims, and then the other 30% is for everything else, whether it's broker comp, overhead, taxes, et cetera. This case right here, it basically shows you why you want to consider self-funding, and it's really a long-term strategy. You have to give it at least 3 years. But you can see that medical inflation in the fully insured market is higher than self-funding. So year over year, you can see in this example, this graph, how the savings accumulated in totality were over $1 million. And if you look at that first year in 2013, they actually paid a little more than they would have versus their fully insured market. But this graph right here really tells you why you want to consider self-funding. It's a long-term play. There might be some immediate savings depending on how you handle funding and contract basis, but certainly more times than not, years 3 to 5, you're going to be able to outpace what you would get in the fully insured market. And you have all your data, so you know if you're getting a fair deal or not. And this is based on a captive comparison, which it's no different than traditional stop loss, except there's another layer of shared risk. And we have a whole nother presentation and product line that we can get into and kind of talk about the differences between traditional stop loss and captive, but the fundamentals remain the same. So just a little bit about AmWINS. If you're not familiar with us, we are the largest wholesaler in the country. That's just a fancy word for GA, or specialty distributor of insurance products. We're a global company. We place about, in totality, about $17 billion across the globe in annual premiums. As far as stop loss goes, that number is about $1 billion, so we have tremendous leverage with all the big name carriers as well as some of the small ones. So whether you're talking about Sun Life, HCC, Swiss Re, or maybe smaller entities like Ulico, Companion, et cetera, we have a lot of business with them and therefore a lot of leverage. And also because we have senior level relationships with the executives at those respective carriers. And our stop loss team is about 150 deep, with about 30 of those being in the sales side of things. So tremendous resources to help with everything from renewal marketing, case installation, staying abreast of claims to make sure that there aren't any issues, et cetera. So we got about 5 minutes left here. Here's just a sample list of the carriers, some that I just rattled off. So with all that we just covered in that brief 20 minutes or so, how do you determine if this is right for your client? Well, we're able to help with that because our actuaries, and this is free of charge, can actually model out based on some pretty basic information as to what the probability there might be savings for a client, and what that number would look like. And we're able to do this from our actuaries' experience and also partnering with Claros, which basically has $100 billion in claims charges across the country, different group demographics. So we're able to forecast, if you will, to help brokers start that conversation and maybe get some buy-in to move in to actually get a quote. So this is just a sample of what those analytics look like. In interest of time, just real quick, in this scenario, that orange highlighted box shows that there would be an 82% chance that this particular employer would save money by going from fully insured to self-funded, and that amount would be the number just above it. So they would realize about a 12% savings. So that's pretty good odds. Anything above 70, 75, probably definitely worth taking a look and delving into deeper. This is what you'd need. And Shelley and Bill, I don't know if we're going to share this presentation, but it's all your basic information that you would send for an RFP. Claims experience, you really don't need it. If you have it, great. If you don't, no problem at all for this particular analytic review. Oh, sorry, got an alarm there. And then stop loss coverage. Don't have to worry about that, especially if you're not super familiar with stop loss. We're automatically going to make sure it's a mature contract basis that accounts for run out. So you have really an apples to apples comparison, a full year of your fully insured premiums versus what you would expect in a full year of claims. And with that said, I'm going to turn it over to Shelley. I can't hear you, Shelley. I don't know if anyone else can hear her.
Yep. Thank you, Henry.
Okay.
And thank you for the overview of self-funding. I think it's interesting how over the past 5 or so years, there's been such an uptick in groups moving to a self-funded arrangement. And you've outlined some great financial reasons as to why employers should consider that. I am going to turn it back over to Bill to close us out for the remainder of the 2 minutes, and we will do a selection of the winner for the charity giveaway. So with that, Bill.
Okay. Michelle, are we going to, I'm sorry, is there a screen you're going to show me with the wheel?
I'm going to turn that on right now. You got it.
Okay. Well, again, as we're closing out, thank you for everyone. I know we wanted to touch upon plan analytics, and we're just run out of time. Next time, maybe what we'll do is just extend the meeting by another 10 minutes to help dive into that. But again, here at BRMS, we do have a lot of analytics to help producers manage, stop loss in general. And so we have a great account management team where we do monthly reviews with both our brokers and clients, quarterlies and annualies. So if any of you are interested in that, let us know. There's also a question that came in regarding, can we email this presentation out? The answer to that is yes. So in follow-up, we will send that out to everyone. Shelley, any luck on our winner?
I'm going to select the winner right now, and we're just going to do it by initial. And our winner is initials SB.
SB, all right, congratulations. So what we'll do is Henry and I will give you maybe a call here or an email, maybe schedule some time to review. But with that, thank you everyone for their time today. And again, we will email the presentation and we will hopefully connect next month on our next stop loss, or excuse me, next webinar. Thank you.
Thank you, everybody.
Thanks.